Struggling to qualify for another investment property because of income or debt? Then the DSCR loan might help you solve that problem. My name is RJ Baxter. I'm an over 25-year veteran of the mortgage industry in the Denver, Colorado market, working nationwide with investors like you. I want to talk a little bit more about the DSCR program and explain what it is and how you could use it in today's video. So first of all, the first thing I want to tell you about is what DSCR stands for. This is an acronym, and it stands for Debt Service Coverage Ratio. And simply put, this is just an analysis of the ratio of the rents from the property versus the overall mortgage payment plus HOA if you have an HOA. Now, the basic idea is this is a loan program that you qualify on the property's income, kind of like it's a little business, instead of qualifying on your own personal income. So this is a great program for someone that maybe can't qualify because they don't show enough income, or like with their job or with their business, or maybe you've accumulated enough investment properties to where the cash flows don't work on the investment properties overall. Or simply, you might want to just reduce the documentation requirements to make your life easier, frankly. Because once you acquire a lot of investment properties, you guys probably know what I'm talking about if you're an experienced investor, the documentation requirements can become burdensome. So this can help reduce those documentation requirements. So this is the basic idea of how it works. We take the rents from the property that you're considering, and we divided it by the mortgage payment, which includes taxes, insurance, and the HOA. And we come up with a ratio. This is the debt service coverage ratio that I've been talking about. Now, how do we arrive at the rents? There's two potential ways we can do this. The first one is if the property is already rented, to use the actual lease on the property for the rental income. The other way is through what we call a 1007, which is an addendum to the appraisal, where the appraiser analyzes the market according to average market rents in that marketplace for a similar property like that one. So either one of these methods can be used to calculate what the rental income is. We just divide that by the mortgage payment plus the HOA if you have an HOA, and that's the ratio. So let's take an example. Let's say you have a property that rents for $3,000 a month and the mortgage payment all in is $2,500. So that would be a DSCR ratio of 1.2. Now, it's a pretty good DSCR ratio. Typically, lenders are looking for 1.0 or above. Essentially the rental income being equivalent to the mortgage payment or maybe a little bit more. The higher the DSCR ratio, the better for not only qualifying, but also for getting a better interest rate on the loan. So the higher that DSCR ratio goes, the better deal you can get. So 1 is kind of the industry standard. If you can get to 1.25, you might be able to get a little bit better deal. Now, you might be asking, what happens if you're below a 1% DSCR ratio? Well, you can still qualify. There's some lenders that go down to a 0.75 ratio. So in other words, you could have a property that's literally upside down on the rents or not cash flowing and still qualify. But that makes the deal a little bit worse. Your interest rate's going to be higher. And a lot of lenders go out the door when you're below 1%. A lot of them won't do it with a DSCR ratio below 1. So it reduces the possibilities of the number of lenders. Now, obviously, as an investor, you probably want to buy a property that has a DSCR ratio of 1 or above, because you don't want to buy a property that's instantly negative cash flow. But that's a whole nother conversation. I'm just talking about how to qualify for the DSCR loan. So the higher the ratio, the better for you and for the property. So that's what you're looking for. So who is this type of loan for? Basically, this loan is for anyone who wants to make qualifying easier, maybe can't qualify on a traditional loan program, or can't produce the documentation that's necessary to qualify in a traditional loan program. So those are the three main categories of people that might utilize a DSCR program. There's one other circumstance where this could come into play, and that is if you're scaling past 10 investment properties. If you're an experienced investor, you know what I'm talking about. On a conventional loan program, Fannie Mae, Freddie Mac, you're limited to 10 investment properties that are financed. So once you get to that threshold, you're just out of possibilities. Well, DSCR lenders, they'll go over 10 properties. A lot of them will. And this by far beats using more expensive types of financing like hard money loans or maybe portfolio lenders that might have higher interest rates. Now, DSCR loans do have a little bit higher interest rate, but when you consider the ease of the process and the fact that you may not be able to qualify otherwise, it's worth that little bit extra rate. Now, why do DSCR lenders charge a higher rate? It's because they consider it to be higher risk. They're not looking at your personal income and your personal qualifying standards. So they don't know if you actually have the income to support your lifestyle. They're just looking at the property. So if if you have a business that's upside down and you're losing money every month, you could still qualify for a DSCR loan, but they don't know that you're actually losing money in your business, which might lead to you having to let that investment property go. So they charge a little bit more of a premium because of the fact that this is a reduced documentation loan, so higher risk to them. Now, when do DSCR loans not work? So the biggest one is if that DSCR ratio is too low. It will not work in that circumstance. If you're below a 0.75, there is just not any options for that particular scenario. So that's something to keep in mind. So as we talked about, the big benefit of this type of loan is no income documentation. You can scale up your investment portfolio a lot more. The process is a lot easier. And basically the property qualifies, not you. That's the big positive of the DSCR loan. So if you have a scenario that you're looking at and you're really curious about what this might look like for your particular property or your situation, just give me a call. I work in all 50 states, and I'd be happy to talk to you about your scenario and run the numbers for you. Once again, my name is RJ Baxter. Have a great rest of your day.